Afternoon, everybody. Welcome. Thank you for joining us on our November Lunch and Learn for the Greentech Network in the Dominion Energy Innovation Center. Really excited to see some familiar names and faces and some new folks as well. We are quite excited to have Jess Hawthorne joining us today to talk about innovative financing options for equipment and growth as you're scaling your climate tech and clean energy business. It's hard to imagine an entrepreneur event across the state that doesn't have Jess at it. It doesn't matter kind of what corner of the state I end up in. I see Jess in Hampton Roads. I see Jess in Blacksburg. I see Jess in Southside, and really excited to continue to have him involved across the state with his Richmond-based company, CSC Leasing. So I'll say this is not totally just about CSC. I think Jess had some really great content lined up in these slides as I was reviewing, and there's a small little sales pitch in there as well, just because they're really leading in this space. But Jess, I'm going to let you kind of formally introduce yourself, but really appreciate you being on, and thank you for helping all these entrepreneurs.
Absolutely. Thank you guys so much for having me. And I'd be remiss if I didn't have a little bit of a tidbit of a sales pitch here, because like you said, Braden, we are one of the leading companies in this space. And so today, guys, we're going to be talking about equipment financing and how it can help scale and grow your business. Some of the benefits, I'm even going to mention some of the pitfalls, a little bit of the different types, and some things to look out for. I'm going to close out with a couple case studies, and then, of course, my little one slide sales comments there on CSC. So first and foremost, let's see, how do we go to the next slide here? Oh, there we go. Okay, great. So about us. Yes, as Braden mentioned, we're headquartered here in Richmond, Virginia. For those of you that are not from the state, we're about 30 minutes south of Ashland, where the DEIC is located. We're a privately held, family-owned business. Been doing this since about 1986. And as I mentioned, we are really one of the leading equipment leasing companies in the early stage, high growth startup world. We currently have over $933 million in assets under management or equipment under lease. And most of that, about 85%, are with VC-backed early stage, high growth companies. We've done just about over $2 billion in transactions. I think we're probably going to hit about $1 billion in AUM here early Q1 of next year. So it's a growing space. It's a great, fun company for me to work it with. I get to meet these great founders from industries across the board. And one thing about us that is significant is we are industry agnostic and equipment agnostic. So what that means is we can work with any vertical and lease you any type of equipment. We work a lot with biotech and life sciences. We do a lot of ag tech, food tech, climate tech, hard tech, specialty manufacturing, and IT. We've put just about everything under lease, from a flow cytometer to electric vehicle. We did golf simulators once, which was, I think, kind of a personal thing for the owner of our company. He's a big golf fan, so I'm sure he has one of those sitting in his basement as we speak. But I mentioned the being equipment agnostic because there is a few finance companies out there that are industry and equipment specific. So I see it a lot with life science companies and IT. So these companies strictly lease either to life science companies leasing lab equipment, or they're leasing strictly IT to a wide array of, most of the time, enterprise level companies. So as I mentioned, it's a great business. There's actually also, I should mention, some OEMs, some original equipment manufacturers that have financing arms of their own that will lease equipment or finance equipment for companies. However, those companies usually avoid startups, and I'll tell you a little bit more about that here in a minute. So, what is equipment financing? So, equipment financing is a smart alternative funding option that complements venture capital and offers substantial value to growing companies that are investors. Equipment financing is a piece of the puzzle, guys. It's a resource for you to manage that capital and spread that capital around. There's a lot of different ways to capitalize your business. Grant funding, which is very prevalent in this space, crowdfunding, equity funding, all sorts of debt options. And equipment financing fits in nicely alongside of that. We're a piece of the puzzle. And if you capitalize and take advantage of those different ways, you can really grow your company and scale your company and use your capital efficiently. So that's what I'm here to talk to you guys about, specifically equipment financing and how it fits alongside these other vehicles. So why lease equipment? First and foremost, and by the way, guys, please interrupt me if you have any questions or if I'm going too fast or if you can't hear me. So I'm also fighting a little bit of a cold, so if I have to cough, I apologize. So first and foremost, preserving equity. Equity is the most expensive capital out there. If you raise $10 million from equity investors and you give up 20 or 25% of the company, and you need $2 million worth of equipment to build out your production facility, you're not going to want to spend that $2 million on depreciating assets. And quite frankly, your investors, your VCs don't want to see that either. They know that cash is king. They understand that you have a lot of other initiatives going on within your company. You may need to hire a sales team. You may need to keep advancing your science, your technology. They don't want to see you spending their money and your money on depreciating assets. And quite frankly, we get a lot of referrals from VCs for that reason. So preserving equity is very, very important. I've heard some numbers out there recently where some of these startups are valuing their equity dollars at somewhere as high as 30-35%. Very, very expensive. So the second reason that kind of ties into that would be non-dilutive capital. So with most leasing companies, the equipment is the only collateral. There's no covenants, there's no warrants, there's no personal guarantees, there's no liens on IP, none of those other traditional handcuffs that are associated with lending. So for those of you that don't know, a covenant is basically a rule up front in the language of the agreement that you have to follow in order to access that capital. So an example of that could be you have to keep a certain amount of cash on the balance sheet. There could be revenue KPIs that are required for you to hit, numbers for you to hit in order to unlock that second tranche of funding. Oftentimes, there are scientific KPIs that you have to hit to unlock that second tranche of funding. So covenants can be very restrictive. They can really hinder you from using that capital for things that may pop up that you may need. As you all know, startups pivot and pivot often. So having that free flow of capital is very, very important. I want to mention warrant coverage as well. Earlier in a previous slide, we mentioned venture debt. Venture debt is a very attractive form of financing for early stage high growth companies, but it can also be very restrictive. Most of you are probably familiar with the Silicon Valley Bank collapse. That was actually pretty opportunistic for us because it dried up some of that venture capital market, or pardon me, that venture debt market. However, as the world has kind of calmed down a little bit in that front, it's starting to come back. So what's really prevalent with venture debt is something called warrant coverage. So warrant coverage is where a company, or pardon me, a lender can enter an agreement and offer 1, 2, 3, 4, 5% warrant coverage. And what that means is that is a percent of either in the investment or the funds that can convert into equity at a later stage at a predetermined price. So 1, 2, 3, 4, 5% may not seem like a lot now, but as you grow and scale and you get that company to where you want it to be, to where you're generating revenue, to where you're going to an IPO, that 1, 2, 3, 4, 5% can be very expensive. I think the highest percentage I've seen this year has been about 7% warrant coverage. So again, 7% of your value might not be a lot now, but 3, 4, 5, 10 years down the road, that's a pretty hefty sum. So keep in mind when you're looking at venture debt, make sure you understand the warrant coverage that can be involved. So that's very important. The other thing I mentioned, personal guarantees. I think most of you all are familiar with personal guarantees. Basically, if you default on your loan payment, the lender or the bank can come and take your house, take your car, take your jewelry. Certainly don't want that. No personal guarantees for most of these equipment finance companies. And the last thing I mentioned was liens on IP. And what I really mean by that is all asset liens. So Again, they can take a lien on your facility. They can take a lien on your equipment. They can even take liens on your intellectual property. And if you've been developing your intellectual property and have spent a lot of money on trying to protect it, the last thing you want to do is enter an all asset lien agreement. So just something to think about when you're considering other forms of debt there, especially as it compares to the single asset lien from equipment finance company, which is basically the serialized CapEx. Another reason why it is important or can be beneficial to lease is to expedite and scale. So it goes back to that preserving equity and using your capital efficiently. By leasing your equipment, you can avoid spending that lump sum of money, of equity dollars on depreciating assets. You can spread out that $2 million of equipment that costs over a term of 2, 3, 4 years. And again, use that capital to hire that IP lawyer, hire that COO, get a great facility, anything of that nature that really drives your revenue and drives your growth. By freeing up that capital, you can afford that. As you all know, cash is king, particularly in the startup world. I know I was talking to a company that just got hammered by their insurance. So they were looking for ways to stretch that capital. The last thing, and I'll touch a little bit about this later, is customized financing. Startups can pivot, they can grow, they can change, they can really find different ways to generate revenue and to change their company and to get where they need to go. They have evolving business needs. And so having a custom leasing facility can really benefit as that company scales and grows. And like I said, I'll touch a little bit on some of the customization that you can do here in a few minutes. So how does leasing work? So there's really two types of leases that you'll find in the market. We're only going to spend a lot of time on one. And it goes back to what I said earlier with some of these OEMs offering their own financial assistance, leases, or just standardized financing. It's risky business working with startups. So the first one is called a capital lease. I'm sure you all are very familiar with that. It's also known as a dollar buyout lease. It's tantamount to a mortgage. So you're going to pay a monthly payment, and then at the end of that term, you're going to spend $1 and you're going to own that equipment or that house. Again, these capital leases are really for later stage companies that have a proven track record of generating revenue. Because like I said, startup is risky business. And by having a capital lease where you're making payments and you own that equipment, once you get to that lease, end of that lease, you own that equipment, there's a lot of ambiguity in between that lease term as to who owns the equipment. Unfortunately, startups fail, and they fail often. So in a downside scenario, it's really hard to know who owns that equipment, and which is why capital leases are not exactly offered to startups. As you know, they also don't have a long track record. Most of them are pre-revenue. So that's why for all intents and purposes, these early stage high growth leasing companies offer what is known as a fair market value true operating lease. And so compare this to like leasing a car. You're going to pay for the use of that equipment. However, that leasing company is still going to own the equipment at the end of the lease. For that reason, or the reason why they offer that is because there's not that clarity and there's not that clarity of ownership. So, for example, the company goes under, a leasing company to come in, collect their equipment, resell it, and make themselves whole. As far as terms for a lot of these early stage high growth leasing companies, it's usually 24 to 48 months. The term length is the easiest way for a company to mitigate its risk. You're getting paid back for that equipment quicker. The most common, though, however, is about 36 months. And I think that's because that's kind of an inflection point, particularly with life science companies or companies that are about to embark on commercialization. They spend about 2 years, 3 years refining their product, building out their facility, and then they're ready to press go. And so that 3-month term, or pardon me, that 3-year term allows that flexibility after that to change their lease structure, enter into a different debt agreement, all sorts of things. Again, payments can be made monthly, quarterly, or annually. I mean, I know I pay my rent check to my landlord once a month. So most people pay monthly. The end of the lease in a true lease, a true FMV lease, is very, very important. While a capital lease may be the most attractive because you do own that equipment at the end of the lease, there's a lot of flexibility in an FMV lease. You have 3 options. You can either extend the lease, you can purchase the equipment, or you can return the equipment to the lessor. Now, when you extend the lease or you refinance the lease, your payment would go significantly down. You've pretty much paid off some or all of the equipment, and so you're basically refinancing that residual value. Your payment can go down for somewhere between 50-70%, depending on what the initial terms are. Now, the purchase of the equipment at the end of the lease is very, very important. You can purchase that equipment for its then fair market value price. And I encourage you all, if you do look into equipment leasing and equipment financing, particularly an FMV lease, make sure you are very familiar and very aware of the FMV structure at the end of the lease. Most companies do one of 2 things. They leave it open-ended, or they cap that fair market value price. So open-ended means they can charge you whatever they want for that equipment. These are mission critical assets. You're developing a product, you're developing a drug, you're going to buy that equipment at the end of the lease. You don't necessarily want to have the cost of that equipment up to the discretion of a leasing company. So something to look out for there. A lot of leasing companies will actually cap that fair market value price as a percentage not to exceed. And they cap that usually upfront in the language of the lease. And it's usually somewhere between 15 and 25%. Sometimes it's as high as 35%, depends on the situation. But most of them do that for a couple of reasons. One is it's capital planning purposes for the sake of the company. Again, like I mentioned, it's mission critical assets. These companies they know they're going to buy this equipment. They're in the midst of R&D. They're on the cusp of scientific breakthrough. They don't want to have to stop their whatever they're doing in order to either give the equipment back or resell it themselves. So for capital planning purposes, they know upfront they're going to spend exactly this amount of money per payment period and know where they're going to pay at the end of the lease. The second reason why they'll cap that fair market value price is kind of a show of good faith. We actually cap that fair market value price. We don't want to be a one-off lessor. We want to work with these companies until they can grow and scale, until they can honestly get a better financial lending terms, till they can get that capital lease, till they can get an unsecured loan from a bank. So it's just very important to consider that FMV structure at the end of the lease. I've heard some horror stories. So I just want to encourage you to really do your homework on that. The last thing is, again, you can return the equipment to the lessor. We see this a lot with kind of some enterprise level companies. It happens a lot with IT. As you all know, technology changes and it changes quickly. Apple comes out with a new computer every 3 years. You're going to want to get the latest and greatest technology for your employees. The second thing about that is 3 years from now, you don't necessarily know exactly how large your company is going to be. You don't know exactly the volume of your products you're going to need to produce. So we get a lot of equipment back from companies that all of a sudden say, "Oh, we got a 10-liter bioreactor. We're crushing it. Now we need a 100-liter bioreactor." Well, we don't want to have the responsibility of having to resell that. We don't want to have that piece of obsolete equipment just sitting there collecting dust and, quite frankly, costing us money. So does anybody have any questions on the FMV lease real quick before I go on?
Yeah, Jess, I have a couple really
Sure.
curious here. So just so I'm getting this right in my own brain, let's say we have a piece of equipment for $12,000 and we have 36 months on that. You're saying as a company, you would buy it for $12,000 and then lease it to us at $4,000 a year plus the interest rate for those 3 years. So we're essentially, you buy it, but we're paying it off as if we had bought it or if we had done an OEM financing on it plus your interest rate. Is that right?
Yes, that is correct. You're exactly right. However, again, we still own that equipment at the end of the lease.
Right.
So one of the pitfalls is it can be kind of expensive. Again, to your point, Braden, you're going to be paying the cost of that equipment plus that interest rate plus that FMV price, but you're not using your equity dollars to do it. It's low touch. It's a one-time underwriting process. You've got the flexibility at the end of it. And you're not really diluting yourself anymore to buy that equipment. And plus, again, these are short-term leases. Your company in 3 years, hopefully, if it all goes according to plan, will be far above and beyond having to worry about that upfront payment from us or from a leasing company.
Yeah. So one more question on that then. So if you guys are owning the asset, does service fall on the leasing company, or would service fall on the using company, the operating company?
That's a very good question. So in most instances, leasing companies will offer what is known as soft costs. And so soft costs are those service agreements, the shipping and handling, the installation, that sort of thing. They usually offer somewhere between 10 and 20% of the total cost of equipment to be allotted for soft costs. It's really up to the company, the lessee, to organize the maintenance, schedule it, but then you just turn the invoice over to the leasing company and they write the check. But a very good question.
Yeah, fascinating. Other questions from folks in the audience, and do just want to give a quick plug. We did have Silicon Valley Bank on one of our prior lunch and learns. You can go find that on our YouTube channel to look at how they actually used to finance climate tech and clean energy companies. But feel free to toss questions into the chat, folks, or raise your hand and pull yourself off mute. Super interesting so far, Jess. Thank you.
No, absolutely. And again, it's so simple, it's so clean, it's not sexy at all, but it is a very valuable tool. And to plug your Silicon Valley Bank guys, we have a very strong relationship with SVB, with Pacific Western Bank. A lot of the banks out there, they will often carve out their venture debt facilities for equipment financing on our behalf, and just take a lien on everything else but the equipment. So just food for thought. Great guy, great people. Was on another call last week with Silicon Valley Bank. So with that said, oops, sorry guys, I'm going way too fast. Carla, you have a question?
Is there a minimum set of requirements for the lender to approve a startup company?
For sure. So good question. It depends on each leasing company. I can tell you how we do it, if that's okay. So for us, like I mentioned, the equipment is our only collateral in the deal. So the equipment is very important to us. We usually prefer off-the-shelf equipment that has a long useful life. As I mentioned, that downside scenario, we can go in, collect our equipment, resell it, and recoup our investment. That's not a requirement. We actually have a lot of very proprietary equipment that we can lease. I'll show you in my case studies a little later. But the other side of the equation, from our perspective, is the credit profile of the business. So we underwrite very similar to a VC in that we look at who the management team is. We look at the cap table. We look at any sort of customer contracts you may already have. We do look at your other debt agreements, again, in case there's venture debt or covenants and warrants are in there that can restrict us from getting our equipment back. And we look at the financials. So we look at, historical, interim, and projected. So what we're really trying to figure out there, Carla, is how much cash do you have and how long it's going to last you. The majority of the companies we work with are startups. So they're going to have somewhere between 12 to 18 or 12 to 24 months of cash. Well, if we're going to do a 3-year lease, we do want to have at least an idea of where those extra 12 months, where we're going to be able to make up those lease payments. How are you going to be able to pay us? So we combine that equipment rating. We actually have an in-house asset management team that's responsible for coming up with the residual value of these equipment. They also are responsible for the reselling of equipment if we ever get it back. And then our credit investment team, we combine those two to get to terms. I will say this, Carla, it is not we don't have like a set metric to come up with these terms. It is a deal by deal basis, a company by company basis. So our underwriting process can be pretty quick as well. We can circle up on that later. But just wanted to thank you for asking the question. Just want to touch on that real quick.
Thank you.
No, absolutely. So customized financing options, particularly as it's related to leases. There's several different ways, several different levers to pull to make it make sense for you. I'm going to start with just the asset by asset. That is just your standard. Hey, I need this equipment. I know I'm going to need this one piece of equipment. It costs $1 million. I don't want to spend $1 million on it up front. I want to break up that cost. And it's one piece of equipment. You come to us or come to the leasing company. We buy it for you. And it's wham, bam, done. That's the most standard. That's the easiest. Just again, asset by asset basis. However, what we see most of, or what's here to the left on the slide, is lease lines. A lease line is a pre-approved amount of credit that you can draw upon to purchase and acquire equipment. So a lease line is very similar to a credit card. You've got a set amount you can spend. It's what you've already been underwritten for, and you can use that, draw upon that lease line throughout the lease to purchase new equipment. So I'll give you an example. Say in your business plan, you know that in the next 6 months, you're going to hire 10 more scientists. Those 10 more scientists are going to need 10 more workstations. They're going to need 10 more fume hoods. They're going to need 10 more microscopes or what have you. Instead of coming to us every time you purchase one, or coming to an equipment finance company every time you purchase one, we're going to underwrite you for that predetermined amount. And you can just purchase that equipment on an as needed basis. So one thing I should tell you a little bit about lease lines, and again, every leasing company is different. Sometimes there can be penalties, just like in a debt structure. If you don't draw down all of that debt, you will pay a little bit of a penalty. Same thing with some leasing companies and their lease lines. If you don't maximize their lease line, then they will charge you a little bit extra. Again, it's something you should look out for. As I mentioned before, companies pivot, plans change. Say you need 5 new workstations as opposed to 10. It's just something to think about. So that's a lease line. Next one is a sale leaseback, and this is my personal favorite. It's very simple. It's incredibly beneficial to companies. A sale leaseback is basically exactly how it sounds. You've purchased the equipment, it's installed, it's in use, but you want to be able to get some of that cash back on the balance sheet and extend your runway a little bit more. A company will step in, purchase that equipment from you, and then lease it to you. That is a direct capital injection back on your balance sheet. You get that $2 million back up front. You pay that low monthly payment, and you can use that cash for whatever the heck you want. So personally, again, it's my favorite. You don't have to worry about the procurement. It's easy for the leasing company because procurement can get a little hairy. But sale leaseback is exactly how it sounds. The next one is actually something that is relatively new out on the market. In fact, Braden, you mentioned Silicon Valley Bank. They were actually offering what was known as a hardware as a service line, something that we offer as well. But that is basically where you bundle your equipment and your service, whether it be a sort of software service, an AI service, any sort of service that's involved that involves equipment. You bundle those together and into one monthly payment, and you can really maximize your capital efficiency that way. So again, for example, if you have if your company capitalizes on monthly subscription revenue and requires hardware to earn that revenue, hardware as a service is a great tool great tool to take advantage of. Sorry, guys, I'm checking the chat here, making sure. Bray, will you might make sure I don't miss anything on the chat?
I'm curious on that hardware as a service. I'm just trying to play this out like in a clean energy environment here. So it's like, let's say we wanted to lease, we were a company that wanted to lease clean energy backup power sourcing for data centers or whatever. Let's call them hydrogen fuel cell backup generators, right? And our service was to deliver hydrogen and possibly do the maintenance and make sure it was operating. But we didn't want to have to go buy all those fuel cells. Our customers didn't want to buy all those fuel cells. We could actually go to an equipment leasing firm, lease that equipment, install it at our customer center. They would get the benefit of that, paying us our service fee, and then we would, cut out, our portion and then pay the lease on that equipment, right? So, like, is that kind of the way that would work?
That's exactly how that works. I can imagine those hydrogen fuel cells are incredibly expensive. There's a lot of upfront cash needed to buy those that nobody wants to spend. And so to your point, Braden, is companies will step in, purchase those from you. You will pay that low monthly payment and still generate that monthly recurring revenue or that annual recurring revenue from your subscription service. And it's funny you mentioned that particular example. There's a company that we work with, and I really wanted to include them in this slide deck. But when we asked them, they were keeping it very close to their chest, unlike the ag tech companies that you'll see in my slides later. His company was capturing carbon from 18-wheelers driving down the highway. So they would actually install carbon capturing tanks on the back of their 18-wheelers, drive around the country, capture that carbon, and when those 18-wheelers got to their docking stations or their depots or whatever, they would plug up a hose. That carbon would go into a larger tank, and then they could capitalize on reselling that carbon or whatever carbon tax credits that you guys know a lot more than I do about and utilize it that way. So again, the trucking company would pay this other startup in order to use their equipment and use their service of having those individual larger tanks at different depots, and we would actually finance all those tanks.
Fascinating. Great example.
Yeah, and I've got a pretty good example of that later here on in a case study, which I believe we're about to get onto now. So these are some
questions from audience members.
Go ahead.
Feel free to raise your hand or drop them in the chat. But continue on, Jess.
All right, great. So again, these are a couple case stories, success stories, and again, I apologize for kind of having an ag focus here. A lot of the energy efficient companies and the carbon capture companies have a lot of very proprietary information, and so they do not want us to share it, because I'm sure if you quickly Google that company I just mentioned, you'd be able to figure out exactly who they are. And if you do that, don't mention I told them about you. So this particular situation, this is just the most standard lease that we see. This is an autonomous farm doing vertical hydroponic farming. They had just graduated from an accelerator in Silicon Valley. They were building out their pilot facility. They had just raised a seed round. They had just diluted their company. It was still a very small business at this point. They needed to build this facility. They needed proprietary robotic arms. They needed racking. They needed packing equipment to package their leafy greens. And they also needed some LED lighting. On top of that, though, they also had to hire 10 more farmers. So they really needed to stretch that capital as far as they can to get their business on track. So what we did is we just offered them our standard lease. I believe it was a 36-month lease, $250,000, very, very standard nominal interest rate, somewhere between 6 and 8%. And they were able to build their facility, maintain their equity. And they actually had another debt facility in place, and they were able to use that other debt facility to hire their staff, something that their venture debt provider, they were able to carve out the equipment financing on our behalf. So it's really beneficial for all parties involved. Again, from the procurement standpoint, A wide variety of different equipment was needed. They worked with several different companies to acquire that equipment. And they were able to do it all through this one-stop shop of this equipment financing company. So again, that's a standard asset by asset, lab build out, manufacturing facility build out, autonomous farm build out, very straightforward. This next example is kind of got a little bit of everything. This has got proprietary equipment. It's got a sale leaseback. It's got a little bit of hardware as a service. It's got it all. So this was a agricultural company that had containerized soil testing equipment that was proprietary that they built themselves. And they actually put these containers at various farms across the country. However, this company had gotten themselves into a little bit of a bind because the cost to manufacture those containers was exorbitant. It was very expensive. And so at the time, they were only able to deploy about 15 or 16 of these containers around the country. And they were looking for a way to finance it. So again, substantial upfront costs, proprietary equipment, a little bit of a hardware as a service. They were capitalizing on some subscription revenue. But we were able to come in, we offered them a sale leaseback. And what that is we bought these 15 or 16 containers from them. We reimbursed them for the cost. They put that cash directly on the balance sheet, and we're able to start manufacturing more of these again at a lower cost. One thing I mentioned was the proprietary nature of the equipment. With that first scenario, there was robotic arms, which are very proprietary, not a lot of resale market. In this scenario, these are custom equipment. It's customized for this specific company. And what we actually did was we got the, I think it's on here, sorry. We got the bill of materials from the manufacturer, and we paid for the bill of materials, and this equipment was just assembled on site. So just a way to get around that proprietary nature. Again, to Carla's question, if the equipment, it's that equation, right? If the equipment is in our eyes not very valuable at end of lease, we'll lean heavily on that credit profile. Whereas if the other way around, the equipment's got a long useful life, it's a forklift, it's a microscope, it's a MacBook Pro, we can kind of look the other way a little bit sometimes on the credit profile or the cash runway. So again, there's ways to work around it. This particular company, again, they were able to get out of that bind a little bit. They preserved their ownership. They didn't want to raise any more capital. They were already fairly diluted. So the equipment financing and equipment leasing was really the right solution.
Jess, can I ask you a question on that real quick? I'm thinking this through. So
sure,
they manufactured their own equipment, and then they sold it to CSC Leasing to then lease it to a customer of theirs, right? So which I assume that lease to their customer would fund the lease, the hardware as a service would fund the lease, but they were essentially able to show kind of revenue twice on their kind of financial statements, right? Because they sold a device, and then they also are leasing this device. I mean, is that some clever accounting trickery there, or
it's a little clever. It's a little clever accounting. It doesn't happen often, but it does happen. And if you want to cook the books a little bit, Braden, you can. Show if you're raising, if you're
it's all your account.
Right. If you're raising another round, and they, the VCs or whatever look closely at that, they will know in a second what you're trying to do. So I don't encourage that. But yeah, I mean, again, and we're not going to. We get the bill of materials, right? So the only way they could really juice that charge to us would be the labor, I guess. But we're going to see right through that. We see how much each piece of equipment costs.
Right.
We're going to see right through that.
Yeah. So with the bill of materials, it still has to be assembled, right? So to the labor component there. Yeah, I'm certainly not thinking in a shady cook the book.
No, absolutely. And I absolutely
operational perspective here. I mean, so were you guys taking at least that materials cost, or were you taking it at materials and labor cost not with labor markup, but just pure labor cost on that.
We took the pure labor costs on that as well, not the markup.
That's awesome.
Yeah. Again, there's ways to be efficient.
Yeah.
So this next one is one of my favorites because
so even if they're doing cost plus labor, it still has to pencil out as profitable on their revenues, because
there's a liability.
Yeah, because if it's cost plus labor for them, that still gets rolled into their lease payment back to you. So it still winds up like they've still got to clear it on the profit side as the sale to their customer, right? Like you have a good enough delta between whatever their service agreement is with the customer and whatever it costs to build goods plus labor.
Exactly. And
you guys, and I guess this gets to it. Do you have like a DSCR ratio that you're looking for on something like that?
I'll have to get some more information on that from you, but I don't think so. But I can get back to you on that. Not really. That was an example that we included because it showed a little bit of everything. We don't do that often. We've got I can think of a handful of companies that we work with where they actually manufacture the equipment themselves. Only a handful. More often than not, for the hardware service, for this next example, drone as a service, these drones are off the shelf. And a lot of times the equipment is off the shelf.
Before moving on to that, we have a question from Will here. Do most customers know the equipment they need, or do y'all provide consulting guidance on off-the-shelf equipment available? Maybe what brands to choose or what types of warranties to get, things like that.
Good question. We can provide some help there. Our asset management team really knows the equipment a lot better than your regional director like me. It's really up to you all to decide what equipment you need. And the benefit of that is you can negotiate with whatever vendor you want to get those discounts. I saw one come across our system last week that said the original equipment value was $777,000, but the company was able to negotiate a huge discount, and they paid $229,000. So we only had to pay that $229,000. But again, we can also offer you connections as well. I had a situation where it was a small biotech company last week, actually, that was having a really hard time finding a Thermo Fisher rep. And so I made a few calls around. They couldn't find one. They weren't set up in the system. And so I made sure I got in touch with the right person, hooked him up with the right person. And that's the kind of things we can do. We're not exactly scientists over here. So if you're looking for advice on what to use, I wouldn't necessarily come to us. But for vendor referrals, if you're having trouble finding people, we can help there for sure.
I thought of another thing. Do you guys only do new equipment, or leases?
I was just about to answer that question. We prefer new equipment, and most leasing companies do, but we buy used equipment all the time. A lot of times, though, if we do buy used equipment, we'll get a third-party appraiser to come in and appraise that equipment to come up with the value of that equipment. I will say when we talk about sale leasebacks, something I didn't mention, usually prefer to do a sale leaseback within a year of the original purchase date, because if it's 5 years old, its values decrease tremendously. So it's not really beneficial for everybody. I will also tell you, personally, we have our own depreciation calculation. It's about 2% of the original value per month. So, 12 months down the road, that equipment usually, depending on what it is about 24% less than the original value. Does that make sense?
Yeah, absolutely.
All right, great. So this one is one of my favorites. One, because I like working with drone companies. They're so cool. And they can really be used for a lot of different things. This was an ag tech company. Oh, hang on. This was an ag tech company. They were usually using drones and AI to survey farmers' fields to monitor pest destruction of crops. So they were able to take their drones, use their AI, take pictures of the fields, figure out where the pest infestations are, and kill the pest, basically. This one was also actually an interesting situation as well, because this company was working with another lessor already, but this lessor was actually really working more on a referral agreement. So this lessor was underwriting the individual farms. So the challenge with that is this lessor could decide where this company could deploy their technology based on the credit profile of the farm. So this company had no control over how they scaled. They had no control over where they scaled, and they really didn't have that much control over the contracts, because by having that third-party leasing company work with their customers, it made things very complicated, and it made it a little transparent as far as what the cost of that lease and that equipment would be. So we came in, we introduced them to our drone as a service model. We were able to roll it up into a one-stop shop. We bundled the drone hardware, the software, and the maintenance into one monthly payment for this startup. And we actually offered them a multi-million-dollar line, a multi-year line, and we were able to cover the cost of their goods sold there. But we also worked with a drone manufacturing company. I mean, it was several $1 million. I think it was a $5 million deal. That's a lot of drones. And these drones are, $15,000, $20,000. That procurement headache is just a nightmare. You've got to worry about all sorts of different things: shipping dates, handling dates, payment dates. A lot of vendors have net 30 terms, down payments, that sort of thing. When you're trying to grow and scale your company, you don't want that headache. So leasing company will step in and basically be your procurement arm. So the result of this one was great. They were actually able to your point, Adam, about making sure that the economics line up. They had greater control of their customer contracts. They were able to make it make sense for them, so they could cover the cost of that lease and whatever other costs that they had, because they had control over their contracts. And again, most importantly, though, they had incredible customer experience improvement. I mean, all of their farming customers were so frustrated, especially the ones that did not get approved. That is the last thing you want as a B2C kind of business. You don't want your customers being angry, or a B2B kind of any sort of customer. So again, I like this one. It's got a little bit of everything. It's got a little bit of proprietary nature. It's as a service. It's got a little bit of a comparison to another leasing company. So it's a really cool one, and it's a great company and a great deal. And drones are more and more prevalent. There's a few of them in this state, as you guys know. I think looking at y'all's portfolio, Braden, do y'all not have a drone company in your portfolio?
Yeah, we have a couple. We have some
Yeah.
drone manufacturers that do a hybrid drone, advanced aircraft company, and then we have some drone attachments and payload systems, as well as some drone as a service type companies to utilities. So we have a few kind of across the board.
Y'all's portfolio is so unique and so interesting. Well, anyways, guys, that's all I have for case studies. I'm going to give my little plug here for CSC and then open it up to questions. So risk appetite and exposure is one of the biggest things that we can offer. Our lease lines go all the way up to $20 or $25 million. A lot of these debt facilities are kind of cut off. We've got the appetite, and more importantly, we've got the risk appetite. Because of the way that we're structured, where we own the equipment, that allows us to work with earlier and earlier stage companies. Advanced technology, again, like we talked about, technology changes every day. These companies don't want to be stuck with depreciating assets, collecting dust. They don't want to figure out how to dispose it, so they can just return it to us. We literally will send a truck, collect it, and take it out of there for you. Vendor agnostic, talked about that over and over. Any vendors you want, as many vendors as you want. Really beneficial if you're building out a facility, as well as like a hybrid facility. For example, you've got one part of your office being the warehouse or the manufacturing side, and then you've got offices in the other side. We can do the IT. We can do some office furniture. and we can do all the manufacturing for you. Again, procurement freedom, touched on that as well. I don't know if you guys have ever tried to buy a $400,000 piece of equipment. It's not really like logging into Amazon and having it show up on your doorstep the next day. There's a lot of caveats. There's a lot of payment stipulations. There's a lot of installation involved. Again, that can all be a headache for a company that's got a million different things going on at once. So we can act as your procurement arm. Committed partner. As I mentioned, we do cap that fair market value up front in the language of the lease. We want to be a committed partner. We want to be with these companies until they can outgrow us, basically. And lastly, increased flexibility. So as I mentioned, we're a family-owned business. We're here locally in Richmond, Virginia. We hold our own paper. We don't have investors to answer to. We can move into new industries quickly and efficiently. In fact, that's part of the reason why I'm so excited to be involved with the DEIC. Green tech, climate tech, hard tech, energy efficiency is a huge and growing vertical. We've got to figure out how to feed the rising population. We've got to figure out how to power our planet. And so we're seeing a lot of investment go towards green tech, climate tech, hard tech. And we can move into that vertical very quickly because we don't have anybody to answer to. So that said, guys, I can't thank you enough. Braden, Adam, the DEIC team, love seeing you guys out in the market. Looking forward to working with you all going forward. If there's ever anything we can do, my contact information is here. Give me a call. We can meet up. We can go to conferences, whatever you guys need. We're here for you. So thank you again.
Yeah, Jess, really appreciate you joining us. We have a couple more minutes and a couple more questions if you don't mind. We got another
Lay
one.
it on me.
Great. Another one from Will is equipment insurance required for the lease, and is insurance provided in the lease, perhaps by you all? Maybe you take care of warranties and things like that come with these large equipment contracts.
So for our structure, the insurance is required for the lease. We do not provide it, unfortunately. We are growing and scaling, not like you guys are as well. We are working on having that capability, but where we are now, it is up to the companies to provide themselves insurance.
Great.
And I can get with you, Will, a little bit later on the types of insurances that are required, property insurance, that sort of thing.
Yeah, to that point, one of the questions I've been having is there a limit on, say, kind of the equipment and its ability to be affixed to real estate? Does it need to stay mobile? Where's your designation between what becomes part of the facility and still kind of an asset that can be removed, that personal property versus that real property designation?
It can be whatever is required. We have, like I mentioned, we do large manufacturing lines. A lot of that is bolted down to the floors or the ceilings or whatever fixtures in the building. It is a requirement, though, to be able to remove it. So to your point, like what we call leasehold improvements are basically if you are adding electricity or circuit breakers or any sort of kind of construction involved, we tend to stay away from. Because again, in that downside scenario, we are not able to collect it and resell it.
Makes total sense. And then one last question for me, and maybe Adam and others have some more that are still on the call here. How should our starter prepare? Like what things should they be getting together if they're thinking that they need some equipment? What's the best way what should they approach you with on that first meeting or first couple of meetings that they already have in hand?
Absolutely. So most importantly, we want to be the equipment quotes, or not, if not the equipment quotes, the equipment information. That's the first step, knowing what you need, or at least having an idea of what you need. That way I can get that information into the hands of our asset management team quickly. The other side is the credit profile of the business. And I can send you, Braden, our information request form. It is basically your cap table, your financials, basically everything you would need to try to raise money from an equity investor. It's a relatively low touch underwriting process from our perspective. We don't necessarily need to understand the product market fit. It's really the equipment is important, the cap table, and the liquidity of the business. So if you have a strong financial model, that is very, very important to us, especially now with the climate the way it is and the capital markets the way they are. I'm personally sick and tired of hearing people say, oh, the best companies get funded. Well, what does that mean? It means you have a sound business plan, you have sound financials. There's another question there. And basically it's straightforward. I'll send you, Braden, if you don't mind, our information request form.
Yeah, please, that'd be great.
Got it all right there.
Like Brian has a question in here. If you want to read that one directly, it might be a little wordy for me to read
Nope.
out, but
I got it. So the question is, well, I can't really answer it for the dollar purchase leases because we don't really offer those. But as far as our operating leases for the personal property tax, we actually pay that on the behalf of the company or on behalf of the customer. And we actually pay per locality as well. So we're tax exempt, but as far as this personal property tax, we will pay that for you and then wrap it up in your rental payment to us.
I want to go back to what you were saying before that question and ask, because I have like a specific example that popped into mind about someone we know who's working on a charging network. And I don't think that they've done a raise yet. And do you work with people who are sort of like, it seems like there would be someone coming to you and saying, all right, for me to get the cash flow to do the raise, I have to have the equipment kind of in hand. Do you have people who show up and sort of do both at the same time, like work with you on the financing of equipment piece at the same time that they're doing the raise to get the cash flow to, make sure that they're in a good spot for the lease payment?
Absolutely. So our CFO will tell you, we don't want to be your bridge loan.
Right.
We don't want to take that risk of, okay, you need 3 months of cash in order to get to your raise when you're going to close.
Right.
But we will oftentimes come in alongside of that equity raise. And as soon as we see that cash hit the balance sheet, we'll press go and start ordering equipment. There's also something, Adam, that we do often that I didn't really mention, but as part of our stipulation, like when you rent an apartment, there's security deposits. So we do take security deposits. It's equal to 2 monthly payments. Those are returned at the end of the lease, assuming all obligations are met. But something we often do, Adam, is we will take extra security deposits as a way to protect ourselves, and then return those security deposits upon the close of the round. So what I mean by that is, say you've got very, very high confidence. CSC has actually talked to the investor as well. It's going to close in 3 months. We'll sometimes take 6 security deposits, and then once that round closes, return 4.
Yeah.
Just again, yep. That answer your question?
Yeah, totally. Because I could see that happening frequently, right? Where somebody is working on a round and they know it's going to involve equipment, and it's easy to just line it up with you and say, all right, because then it would make both sides feel a lot better, right?
Oh, absolutely.
Feel a lot better if they know this is exactly how the equipment's going to get bought. Here's how it's going to get paid for. Here's what the cash flow is going to look like. So they know what the burn rate is, right? And you all know where the payment's coming from for those 24 months or whatever that they're doing the burn.
Yeah, you're exactly right. It's all about getting comfortable with the situation.
That's cool, man.
Yeah, Jess, we really appreciate it. We're right at the top of the hour here, and can't thank you enough for joining us to talk about this really fascinating subject. We'll be posting this online here in the next few days, and if you missed it or if you have friends that would like to rewatch it, please feel free to pass it out. And Jess, thank you so much. We look forward to seeing you around the state.
Yep, thank you all so much. Really appreciate it.
All right, have a good one.
Have a great
Take
one.
care, guys. Thank you again.